North American Income Trust is a well-diversified best ideas portfolio of 35 to 40 cash-generative companies. I'd like to think that over the past year, we've probably remained a bit more defensive than usual, given sort of the backdrop of the markets and the macro. I think instructively that in the last month, we saw a little bit of volatility with the financials and the banking system in the U.S. What we've been able to do is add to some of our highest conviction names, not necessarily in the financials area per se, but when all stocks sort of get dislocated due to something, exogenous, we tend to look to our highest conviction names, see if they've sold off, and simply just add to those. So right now, our top 10 names are now up to 40% of the portfolio, and our top 15 names are 55% of the portfolio. I think when we look at the Fed, the biggest change, coming out of the pandemic was the Fed having to fight inflation. So we went from a period of deflation or perhaps disinflation to inflation, given some of the monetary and fiscal policies. The Fed now has been forced to raise rates at a pretty aggressive clip. They've gone from a Fed funds rate of essentially the zero bound to something at close to 5% right now. So I think when you look at that backdrop and you look at fiscal policy, which has gone from being quite generous and handing out checks to each and every one of us to something much more normal, I think that backdrop, makes something a little bit tougher for the U.S. consumer, a little bit tougher for the market. And then finally, we sort of dovetail those together by looking at valuation and, what is the market pricing in? And I think when you look at the headline sort of market multiples, we don't find that particularly compelling. We see the market multiple trading roughly 19 times forward earnings. But if you were to step back and look at valuation a little more carefully, you'd see that growth stocks are now trading north of 25 times forward earnings, value stocks, income stocks, if you will, trading in the mid-teens. So that sort of 10-point gap from 15 times to over 25 times is quite broad. It's nearly 2 standard deviations larger than history. And then, when you look at the North American Income Trust, our average multiple is roughly 12 or 13 times. The median multiple is roughly 14 times. And I think that when you look at what you own in the North American Income Trust, what we own, we have that good group of companies trading at sort of that mid to low teens multiple, paying, a dividend yield approaching 4% that is covered and is progressive and has grown each and every year. So when you look at that all together, I think, the cost of capital has gone from essentially nothing to something, much higher, whether it's 3, 4, 5, 6%. And I think in that environment, valuation matters, and valuation should matter a lot going forward. So we've just released our fiscal year-end results for the period ending January 2023, which is our fiscal year. During this time period, the share price of the trust was up 12.4%. And since the discount has narrowed, the NAV trust was a little bit more modest, 9.6%. This compares to our benchmark, the Russell 1000 value, up 8.5%, while the broad-based S&P was down over 8%, given FANG weakness. We've been able to pay a progressive dividend since the conversion of the trust in 2012, and we were named a next generation dividend hero following the 10th anniversary of the trust's conversion in 2012. Revenue reserves remain in excess of a year, and we fully expect to put the board in a position to continue to pay a progressive dividend and keep that reserve above the 1-year threshold. I think when we look at the last few years, I think, we had a lot of volatility during the pandemic, and sort of subsequently, over the last 12 months or so, turnover has generally ticked down to something, much more modest, below 50%. And in this type of environment, obviously we continue to look for new names. We continue to exit sort of holdings where we have less conviction. But most of what we were doing is sort of topping up laggards where we still believe in the thesis. We believe in what they're doing is the right thing. And we may top slice stocks that have performed well or valuations that expanded to sort of a wider range of outcomes. We did add a water utility, a company called Essential Utilities, earlier in the year as a nice defensive holding with a good growth outlook. And we did consolidate our consumer holdings by selling what we believed was probably one of our weaker holdings and putting that proceeds into one of our stronger holdings. Yeah, so typically we're looking at companies with fair valuations, good cash flow prospects, good management team, and good market position. So a company that we've now owned for a few years and we've actually added to during some of the recent dislocations, a company called FMC Corp. And what FMC does is they're a company that manufactures crop protection chemicals that help farmers increase their yields. We believe that we expect to see FMC to continue to have strong volume growth. And at the same time, we expect margins to recover to pre-pandemic levels given FMC's pricing power. And at this company, valuation is actually fairly reasonable. It's roughly 14 times forward earnings for a company that we think is in a secular growth type position over the long term with above average margin profile. So that's FMC. Another company that we like a lot, it's a bit more expensive, is a company called Analog Devices. And what they've seen is a little bit of a current demand slowdown in semiconductors. It's a semiconductor manufacturer. We think this will prove temporal, and we believe that their exposure to some of the strong end markets, such as industrial and automotive, will put them in a position where they can continue to grow. And we believe the markets are much more willing to pay up because given their tremendous free cash flow generation abilities. This stock's currently trading at roughly 18 times, so something slightly below market multiple, but above the North American Income Trust average of low to mid-teens. Yeah, I think the macro remains, quite a bit difficult here. We've talked about the Fed. The Fed, is still trying to fight inflation. We've talked about fiscal policy being, sort of less friendly as the government sort of has to tighten their belts here. So I think, when you look at that, you try to find companies in a best ideas portfolio that are a bit more insulated from the broader economy or has sort of company-specific initiatives that we believe, can help grow beyond sort of a macro that is a little less forgiving. Themes we've talked about is technology. We talked about Analog Devices. There's also a company we own called Broadcom that focuses on mission-critical applications with strong market shares and low competition. And then we've also talked about a company like FMC with their agriculture exposure. And then finally, a company, L3 Harris, which is a defense contractor, which we think, given the sort of the macro, geopolitical outlook with China and Russia and whatnot, we think that's well positioned to grow in that type of environment.